for us, the next level is usually another fund, and liquidity drives that. Okay, we don't need any particular piece of technology to get there. If the existing investments exit profitably, all of our investors will re-up for another fund. So that's always, plan A, and it's largely out of our control. But things are looking pretty good. The exits are happening right now, and the prices being paid for stocks like Figma are pretty good. And there's a whole bunch of companies that are watching the Figma IPO as a barometer, and they'll go out right on its heels. Okay, so I expect this year to be a pretty good year. It's been a good year so far, and it's probably going to stay a good year. And other things operationally in the back office, the AI, like all other companies, is changing our workflows. So we're taking advantage of that to make our life easier so that we could, process more information.
Welcome back to another episode of the Big Hitters Podcast. I'm joined by Scott Chou, who he was just actually correcting me on the pronunciation of his name. And he is the founder of a very cool venture capital firm, the ESO Fund. And they have a really unique model for what they do. And we've haven't had someone on the podcast that does something kind of similar to this. So I'm excited to kind of dive in. Scott, my question's always the same to start. Just tell us a little bit about who you are and how we got to where we are today.
Sure. Thanks, Andrew. Glad to be here. So I'm a long-time venture capitalist. I've been doing this for over 27 years now. I got into the business through something called the Coffin Fellows Program. And for the first 15 years, I did traditional venture capital direct investments in the companies and sat on their boards, early stage companies, and did the usual thing. One of the things that I observed along the way was the number of people who simply did not exercise their stock options, and it was huge. Okay, and the place where you see it the most is that when you do an M&A event, back in the day, they made printed copies of all the closing docs for every participant. All right, one for the buyer, one for the seller and the board members, selling stockholder, and these were huge. I mean, the lawyers are paid by the pound, and there's one particular box that was called the schedule of exceptions. It was loaded. Those are the contracts and other things that are warnings for the acquirer that these are potential issues. And I said, wow, that's a lot of issues. Schedule exceptions is bigger than the other stuff combined. And you open it up, and all it is a bunch of option grants that were all unexercised. I said, why are these included in the schedule exceptions? And the attorneys would say that, well, because this company turned out to be so successful, some of these people are going to come out of the woodwork and claim that, hey, when you told me I was vesting, I thought I had stock. I never realized all I was simply doing was vesting the opportunity to invest in the stock. I never realized I had to write a check. If you had explained that to me more clearly, I wouldn't be coming away with this with nothing. All right. And even the people who knew that they were supposed to exercise stock options, some of those guys might come out of the woodwork and say that, hey, if you had told me more, I would have invested. Because right there's a little disclaimer at the beginning of the option grant that says, you know what you're doing if you exercise, since you're an employee. Therefore, you're exempt from all of the usual SEC requirements on investor disclosures because you're an employee. The fact is, everyone who works at a company often knows, especially when the company gets big, is that the rank and file, they aren't necessarily told a lot. Okay. So like the valuation of the company, all these details, and just exactly how healthy are their bank balances, all that stuff they don't know. So it's not that easy for them to invest. And so they don't exercise either. And then, of course, there's people who do exercise. They oftentimes can't exercise them all. And that's like the biggest opportunity of all. Like, you love your company, but when you join the company, you negotiated hard for a big grant, a life-changing grant. And the flip side of that grant is that if you find yourself having to exercise because you found a better job or you got laid off or whatever, is that you have to write a check. Because when you negotiate for a grant that's multiples of your annual salary, that means you have to cut a check for multiples of your annual salary plus the taxes. And if you can only do 10% of it or 20% of it, then someone's got to help you with the rest. And that's basically the story for ESO. A lot of people don't know they need to exercise. I help those people. A lot of people can't afford to exercise 100%. I help those people.
Okay, hold on. I just want to make sure I understand this. So let's just say, for the sake of argument, I was an early employee at Uber or whatever,
Mhm.
PayPal or I don't know, any of those companies, right? And I have all of these I guess all the grants, whatever kind of grant it was, if it was preferred stock or however it looks. So what you do is you find investors to come make someone like me an offer, right? For those grants. Is that correct? Am I understanding that
Well,
correctly?
we are the investors, so we're a fund. You're right. So the LPs in my fund, so we're a fund like any other venture capital fund, except we have a different strategy. We're giving our LPs exposure into really cool, Silicon Valley, startup scene companies, you know, more than they would see in the normal way. The normal way is that you'd have to have a 50-year relationship with Sequoia, doing one fund after another, and eventually you have exposure to a lot of companies. But with ESO, you could be an LP in our fund, and you would instantly have exposure to a couple hundred companies per fund, right? So that's that part of the story. So on the client side, the employee side is that you don't have enough money to exercise your options and pay the taxes. So I will pay that for you from the fund. I will take all the financial risk, and we split the profit. That's
Mm.
what you pay. In other words, you don't have to pay me back like a loan if it goes sideways, because a large number of startup companies will not make a decent exit. The
So the
majority.
benefit for your fund is it's basically like you are investing in an extent in early stages in Uber. It's not, you're not necessarily having to go catch lightning in a bottle investing in these risky startups. Like these are brand name companies that have become household names, and you're getting a piece of the action, but it's like you got a piece of history
After the
in a
fact.
way. Yeah.
Yeah, got it after the fact. Granted, I don't have the price that the early stage investors has, but I still, I got a participation in a
Yeah.
large number of famous companies. Right.
Hmm.
So from my perspective, I could choose what to participate in after the fact. I don't have to be smart enough to know that Uber is going to be awesome at the Series A. I could wait till Uber is famous, okay? Because the employees that come to me, they have grants that were issued like several years ago when they were hired,
Yeah. Yeah.
okay? And those grants, the cost to exercise those grants plus taxes is not as high as investing in the latest VC round.
I would imagine, so I'm a financial advisor by trade, and I would imagine there was some regulation and red tape from the SEC or FINRA or somebody. Like, was there anything that you guys had to figure out to make this kind of transaction work, or was it pretty easy?
Well, the biggest things is I make it sound like it's kind of easy. It's not as Uber is a good example of something that's so famous that the general public knows, and there are probably random people on the street that would have invested in Uber, although they still have to know what price that's safe to pay. I mean, you can't just pay any price. And also, there's thousands of companies out there. I mean, if you look at the number of IPOs in a single year, I mean, it's over like 100 in a normal year. Not last year. This year might be it's more than in terms of household names. So knowing the companies that are good isn't that easy. Not everything's like Reddit or Uber or something that's a consumer facing, or Facebook.
Yeah.
The vast majority of them are just some nuanced piece of enterprise software that the vast majority of the people in the general public haven't heard of. So the biggest challenge is knowing what you want to do and knowing how much is safe to pay. All right,
Mm.
and the definition of how much we're paying is sort of like the split. In other words, I negotiate a split. Our typical split is like 2/3 for you, 1/3 for me. Okay, I
Even that,
pay.
even that, I like. I mean, that makes me feel like I'm winning. Like I'm keeping a majority of the action, and you're
Yeah,
the 1/3 is like you're. This is a headache I didn't even want to mess with.
that's right. Right.
Yeah.
It's a good deal. You don't take any risk. You still get the majority of the eventual proceeds. Um, but well, when things don't fit that model, we'll have to say no, on occasion. But it's at least we're there. And
Do I
we've addressed.
do I sign a piece of paper, Scott, saying, "Hey, these Uber grants are now your grants," or how
No,
does that look? Yeah.
you keep everything. It's kind of the document is kind of like a loan until it's due. Okay, and the due payment is limited to the value of the stock. So if the company goes out of business, you you give me nothing. Right. I write it
Oh,
off, and you just go on with life. So
oh,
basically, you only have upside. You don't have any downside risk.
yeah.
So, and the money, I also explain to people that who get obsessed over 1/3, because even at 1/3, there's like an implied value of that 1/3, and they feel that I didn't necessarily put enough money in to justify 1/3. I point out the fact that you didn't have to invest anything to get the other 66% for nothing. Okay.
Hmm.
So your total return is not 66%, but the fact that all of that money that you would have spent to get it, you could now put it in something else.
Hmm.
So your total return is actually the sum of those two investments. And they realize that number is actually higher. Even if it's not higher, it's at least safer because it's more diversified. You have more
Hmm.
assets, and rather than concentrating all of your personal wealth into a single stock.
Hmm.
So once they get that, then my business becomes a lot easier.
Hmm.
They realize that I'm playing a valuable service. I'm picking up a lot of risk, and I create tax efficiencies too. We spend a lot of time discussing the taxes and how we can structure a deal to make the taxes lower than if they were to do the deal by themselves, and
Man,
that's a huge win.
that is a huge win. So as a financial advisor, I can think about a few clients I've had that have had grants from places like Nvidia, Sales, you name it. Like,
Hmm.
and it is a nightmare, right? To think about the implications. If I want to sell $100,000 and liquidate, like the IRS is going to rake me over the coals, right? And so the fact that you found a good solution for that, it's really powerful. So how do people find you? Like, where do people just like know who you are? Are you the guy,
Well,
for this
there's
kind of thing?
it's snowball effect. I mean, since we've been around for like close like 13 years now, so we have thousands of prior transactions, and even many times that in terms of inquiries. So those people know us, and they do a lot of word of mouth. So we do a lot of word of mouth business. But in terms of finding people for the very first time, the bulk of that is as you mentioned earlier, the taxes. So we produce a lot of white paper content on the internet about mitigating taxes, calculating your taxes related to stock options, and people find those papers about how to save money on taxes. Okay, and then we kind of say on there, oh, by the way, if you need help paying for this stuff, you can just contact us, and we'd take a look at it for you.
Yeah. All right. Where do I want to go next? Let's talk about sticking points that you have in your business. So, real quick, just to give the audience the concept of big hitters. You're doing big numbers. Out of curiosity, what is like the total that you have under management or the size of the
It's
fund?
500 million. 500 million. That's from the fund perspective. So we're not a gigantic multi-billion-dollar fund. Then again, we are working in a niche market. $500 million venture capital firm is still a significant. And plus, we're always raising more because as we deploy the money, then we turn around and raise more of it. So I
Yeah.
add a few hundred million to the bucket with every fund cycle. So we've done 5 funds so far, and we'll probably do fund 6 maybe next year.
Okay. I'm curious. Are there any company? I don't know if you can even say this, but are there any companies that you're like, wow, I run into that company a lot in terms of like grants or options or anything like that?
Oh, we don't like to talk about the active ones because in my own self-interest, when I tell the whole world what I think is really hot, the next time when they contact me, they have such a strong negotiating position because they know I really want it. It makes those deals a lot harder to close. Easy. And also enables our competition to pursue and run up the prices on those stocks. But we're interested in uh, all the usual things that the other people are interested in.
Cool.
There's quite a few AI stocks out there, a lot of enterprise software out there that's doing well, and we are very open minded. Besides the 2 dozen really famous companies out there that everyone will do, there's a few hundred right behind it that are good enough from our view that aren't famous, and we're happy to transact in those. And that's where I think we provide pretty big service.
All right. Let's talk about sticking points in your business. So, I'm sure it's like, well, I just at the point you are in your business, like, what are some things, some problems you're trying to solve? Not necessarily things keeping you up at night, but what are some sticking points you're trying to solve for?
Well, there's the awareness. You mentioned that. We do have to. We're not a big company. We're not a certain famous household name, so we have to catch people. You know, uh, who are trying to solve this problem. Okay, there's a lot of people out there trying to solve it, and they don't know about us. So we're doing a lot of proactive marketing. Uh, uh, a lot of that's based on job searching. People who are job searching on the internet tend to be in transition from companies, and we can see from their LinkedIn that they used to work for one of the companies that we like. So we can contact them proactively, and we use AI to send a lot of emails and to do first replies to a lot of emails. So and that helps help that helps with our reach. Of course, we generate a lot of white paper content, and we generate a lot of consultation time on the phone for those
Mhm.
people, to get them into the front end of our funnel, and all of that. That's work on us, and that's the biggest thing is simply just getting it out there. And once we get them into the front of the funnel, the main sticking points there, a lot of it has to do with the lack of competition. If we had a little bit more competition, I'd say that we would be more validated. In other words, one of the issues that people have is how do they know they're getting a reasonable deal? Okay, the easiest way to know that is if they've already called two or three other people. Okay, then they see the terms are sort of like market or whatever. They can make a decision a little easier.
Yeah.
And those would be major enablers. Um, the biggest issue in terms of just the business in general for us is the health of the IPO market, and I'd say that's coming around these days. For the last few years, the the problem, the top of mind problem, wasn't necessarily sourcing deals, but simply getting out of them. Making investments is actually pretty easy compared to waiting for the companies to go public. All right.
Yeah.
So, and now that's happening. As the companies start to go public, then the number of what we call secondary tenders, where the current investors in the company itself, they'll buy you out. That's way up. All right. That's
Yeah.
because that's because they themselves think that the IPO is not too far off, so they can afford to put some money and redeem some of the employee shares, and that liquidity, flows through me to our investors and allows us to start another fund.
Yeah. All right. Well, yeah, let's talk about AI for a second. So that sounds like you're using it to acquire clients and to message with prospective clients. What other ways are you leveraging it, and where do you feel like you could be using it that you're not?
The code we use it even more on the code generation side. I mean, it's a force multiplier on productivity. So the myself and the engineering team, the data science team, we have a lot of our company really is an e-commerce company more so than a venture fund. I mean, financially we're a venture fund, but the way we operate based on the large number of clients, the inbound inquiries, stuff like that, it's almost like an e-commerce company with transacting and DocuSigns and paperwork flowing and the execution of the diligence. We can't like produce these binder memos like a regular fund will do for each of their deals because they're only going to do like 20, 25 deals per fund, where we're going to do several hundred, maybe like 400 per fund or more. And so we're transacting basically about one time every business day throughout the year. And that requires software to juggle all this paperwork and to process things, money, wire transfers, all of that is automated. So we have to write software to man. That's the way it's been, since long before AI. We were always doing it that way. And now that the all these coding tools are out, our productivity is way up in terms of our ability to first draft code very quickly using AI, and also to write tools like on other platforms that we don't know how to do. So tools that help our website, these Chrome extensions and our iOS applications and stuff like that, where we know maybe a little bit less, we can actually have the AI first draft it in its entirety, and then all we have to do is kind of modify, enhance, and clean it up. So that's a big bonus. On the data science side, we're also using AI to well, our data science platform is kind of AI to begin with. We've been a machine learning platform from day one. In other words, how do you diligence all these thousands of companies, most of which you've never heard of? And that's because we've literally invested thousands of times over the years, and we've had over 1,000 exits so far. So you take all of our exits, good and bad, and you feed that into a machine learning model against all of the variables, all the pieces of data we had on the company, we end up building a predictor, and that predictor allows us to make quick decisions when people call in from companies we've never heard of. It makes
Mhm.
a quick. It doesn't. We don't let the predictor invest on its own. It's like a bot, but it does a quick thumbs up, thumbs down, so that we know to proceed with a traditional, human intervention.
All right. Um, what are some things that you think will need to happen for you guys to get to the next level? Like, where are you trying to go, and what do you think needs to happen to get there?
The next level, okay. Well, for us, the next level is usually another fund, and liquidity drives that. Okay, we don't need any particular piece of technology to get there. If the existing investments exit profitably, all of our investors will re-up for another fund. So that's always, plan A. And, it's largely out of our control, but things are looking pretty good. The exits are happening right now, and the prices being paid for stocks like Figma are pretty good. And there's a whole bunch of companies that are watching the Figma IPO as a barometer, and they'll go out right on its heels. Okay, so I expect this year to be a pretty good year. It's been a good year so far, and it's probably going to stay a good year. And other things operationally in the back office, the AI, like all other companies, is changing our workflows. So we're taking advantage of that to make our life easier so that we could, process more information. It's not critical. We have enough staffing to handle what we're doing, but to the extent that we make stuff easier, more accurate, we're always. I mean, there's not a day that goes by where we're not developing back office code, workflow code, and uh, yeah, so that continues. I wouldn't say there's any bottleneck there that's preventing any particular action. You know, there's like people often ask, "Well, you want to go completely automated, have AI sales, and have full interaction?" Well, we could do that. We haven't spent a ton of time, and we do generate some automated emails. But our current philosophy is still to get the person in front of a human as quickly as possible. Okay, because I think that the nature of our contracts, these six-figure contracts, and sometimes seven figures, there's a trust factor, you know, because you're dealing with an unknown entity before you sign contracts with an entity that you found on the internet. You sort of have to develop a personal rapport. So the
Yep.
sooner we get that process started, the better off we are. The more likely it's going to close. Yeah.
Mm,
I mean, there's no doubt that's the case because if you look at our business, close to half of it is word of mouth referral.
yeah.
So that alone tells you that that matters a lot. So we're still
Yeah.
going to keep focusing on that instead of being a completely automated e-commerce shop.
What's one thing, Scott, we haven't talked about today that fires you up?
Well, okay. The we're we're the the other things that are right around the corner. Okay, and that's like an internal staff staff question. All right, and it turns out it has never been as big a deal as it theoretically is because the nature of our model is that even if we're a little bit late to recognize, let's say like we're one year into a new trend, like we're at the front end of AI, go back a few years, and
Yeah.
we're one year late. Okay, but now people are picking up. Maybe they saw ChatGPT for the first time because our model, based on options that people got a few years earlier, allows us to still pursue them after the fact. So that hasn't been an overwhelming thing. The um, the the crafting of vehicles to address other financial opportunities. That's on the table. I don't want to announce too much, but there's a based on all these calls that come in, there are other things that people want help with. Like for example, I'll like capital gains tax. Like if you have a ton of stock in a company, right? If you were to cash it out all of a sudden, like in California, you'd lose half of it to taxes. Okay, but you do want to cash it out in order to diversify, all right?
Yeah.
And to get something a little safer, maybe keep a little bit to go along, but you don't want to be too concentrated. But if you lose half of it, I mean, the financial cost of diversifying takes quite a bit of hit. How can I diversify your position without you unloading all of your stock? So there's a lot of things that we're working on and advising and help our clients with to help them solve problems, basically to help our core business and perhaps expand our product offerings as well. And there's also shareholders. I mean, we talked a lot about option contracts. We're also putting things together to help people who already have their shares, help them monetize, help them do things without tax efficiently. And that's a big thing. I'd say that's bigger than our primary market, in its entirety, helping
Yeah.
people with existing shares. You know,
Scott, if people want to learn more about who you are and what you do, where can they go?
well, the website is esofund.com. It's also employeestockoptions.com. And we're on there. Our emails are on there. Phone numbers are on there, and they go right to us. In fact, you can even book appointments, right with me. There's no filter on it, and as well as the rest of the staff. And we're always ready to hear another story from another company. We always need information, even if we never heard of the company. Love to build a file on the company so that so that we can handle, you and your colleagues down the road as they come by. And also, I love the fact that just talking to these people because just as a VC, you just sort of want to know about these companies and how they work, and that's kind of cool.
Yeah.
I mean, you get that a lot in all
Yeah.
these interviews. It's,
Yeah, so I feel like I've just from my podcast gotten a master's. I have another one called the Builder's Bible, and all of a sudden I'm knee deep in construction stuff. And so, yeah, it must be fascinating to have those conversations with those employees for sure.
yep, these are the smartest people in the world by definition, sort of, and they just call me, and I get to have a free conversation. I do have to pay for their stock options, but that's something I want to do.
Yeah, yeah, yeah. Well, hey, don't go anywhere yet. I want to chop it up with you a little bit, but thank you so much for
Sure.
coming on the podcast, guys. Check out Scott and what he's doing. It's really innovative. I've been in financial services to one extent or another for close to 20 years now. This blew my mind that this existed, and that's really cool. So if you know anybody that worked at one of these tech companies potentially with that kind of a setup for pay, then have them check out Scott and what he's doing over there.
Thanks, Andrew.